I think we're going to have some growth fears, which we should when we have faced a real threat, which is inflation.
The volatility market has essentially already gotten used to this new normal.
There's questions about how aggressive the Fed will be or needs to be kind of in this evolving environment.
Let's not kid ourselves. They are still way too stimulative for what developments are and what forecasts are.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
From London and Berlin on this Friday, December 31st, our top stories today. It's out with the old year and in with the new. Stocks and futures are steady as 2021 comes to a close. Another day, another coronavirus record. 2 million daily cases are reported for the first time since the pandemic began. Some of the biggest Wall Street banks are telling their employees to start off the new year by working from home. And one of the biggest risks in 2022 may be geopolitics. Joe Biden and Vladimir Putin talk as tensions over Ukraine keep rising. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Matt Miller in Berlin. Kailey Leinz and Anna Edwards are off on this New Year's Eve. Matt, I, for one, am hoping that the market remains calm today because I'd rather spend the day picking out what bottle of bubbly I'm going to be drinking rather than what hedges I need to be picking.
Well, you're not on the air for the next 7 hours. I'd like to see some volatility here, but the truth is there aren't going to be very many markets open. Happy New Year's Eve to you. Take a look at what's going on in Asia in terms of the moves that we saw. You had some markets closed, some closing early. Here you see the MSCI Asia Pacific up 0.5% right now. A little bit of a move in the Japanese yen. I saw a bigger move earlier. For a moment, the BBDXY dipped deep. But you can still buy 115 yen. That just shows you the strength we've seen in the dollar. The Hang Seng up 1.25%. I believe the Hang Seng closed early. Danny, correct me if I'm wrong. I think you told me that this morning. And then the iron ore contract is the big commodity mover that I saw in Asia, up another 2.5%. We had a move up again yesterday as there are some inventory movements in and around China. In terms of what's going on here in Europe, much of Europe is closed today. We're prepping for some big New Year's Eve concert here at the Brandenburg Gate. The German market is closed. You see a lot of color on this screen. I'm going to talk to the programmers about this. We need to put a big black C in the markets that are closed, since almost all of these are actually closed right now. The only markets that are open, the FTSE is down 0.3%. The CAC Current is down 0.3%. The AEX is open but unchanged here. You can see there in the Netherlands. So there isn't a lot going on in terms of the markets today, and we're going to see early closes for the FTSE and the CAC as well. Here you can see those movements and the absolute numbers, 73.81 on the FTSE, 71.52 on the CAC. The euro dollar, which I keep close track of as I prepare to move back to New York in 1 week. From today, I will be getting on a plane with my wife, my daughter, my dog, and 2 cats. And natural gas coming down 13%. You can see that's been an incredibly volatile contract all year, and that volatility isn't ending on New Year's Eve. Danny, what do you see going on in the U.S. markets?
Well, there we go. We found the one asset today that's giving you that desired volatility, Matt. That's fantastic news. I have a lot more of calm in these U.S. markets. Of course, we saw U.S. equities dip yesterday from an all-time high. Volumes are really light, but it is interesting to see that typically at year end, we'll have institutional investors who really double down on the year's winners, perhaps take some profit away from what didn't do well, but it's pretty steady at the moment. So not getting a great sense of how institutions are positioning on this last trading day of the year. So S&P 500 futures down less than 0.1%, leading the losses in the U.S. future space. You have NASDAQ and small cap futures down more than the broad benchmark. You also have NYMEX crude taking a bit of a breather. We don't have the percentage decline up today, but NYMEX crude is on track for its best year since 2009. Really that demand coming back into the fore in a post-COVID world. So any declines today aren't really going to help to dent that really rip-roaring rally. And Matt, it's really interesting. You mentioned European gas prices plummeting in Europe. You have more supply coming into the market. Well, in the U.S., we have prices moving higher. There we go. We have a decline of 0.6% for NYMEX crude. But for natural gas, it's a rise of almost 3% today. It's cold weather that's really impacting the U.S. Across much of it. And this means that natural gas is on track for its best year in terms of gains since 2016. Finally, I have the 10-year yield not giving us a lot of direction today, around 1.5. Of course, interesting to see it do almost this round trip for the entirety of 2021. Now, I want to stay with yields, but move on to the credit market more specifically, in part because of this low interest rate environment. You have 10-year yields continue to stay low. We've enjoyed a rally through much of the credit market. Here, I'm specifically looking at Europe. I want to welcome our radio listeners as well. I have a chart here of CCC bonds, bonds across the B space as well, and investment-grade bonds as well. And for this year, yields just continued to trend down, no matter where you were choosing in the space. In other words, you could probably safely bet on any of these indices. But what happens next year as we get tightening policy from the Fed? Can it last? Well, joining us now to discuss is Dana El-Botaji, Bloomberg managing editor for EMEA Credit. Dana, thanks so much for joining us this morning. So as we look into 2022, what needs to change in terms of strategies for people who are picking bonds in this space?
Well, exactly as you said, this year has been an amazing year for those who just invested in an index. It was just incredible. You can invest pretty much anywhere and you would have made money. Next year, it's really about looking at the fundamentals of every single company. You want to drill down to see whether or not they are exposed to high material prices, inflation, where their revenue is actually coming from, whether or not they raise enough cash in order to give themselves that cushion that they really need in order to make it through an environment where interest rates are actually going up. And of course, now, given the fact that there are different central banks that are doing different things, you now have a world where you want to try to find the best borrowing costs. And frankly, Europe seems to be that place. And that's one of the reasons why people expect that the euro might be the funding currency of choice next year.
By the way, Donna, I imagine that, so you're saying basically it's not about passive, it's more about active in 2022. And I imagine that must be much more difficult, especially for a retail investor in credit than it is in stocks, right? I mean, it's much easier just to buy an index and go along than look into individual companies and drill down.
That's exactly it. And I think what you'll find, and what many investors have told us, is that the analysts who have been sitting back and had a fairly easy year this year will probably be needed more than ever next year. People are actually going to be reading those analyst notes as opposed to just skimming through them for the basics. This time around, people want to know what companies are doing to actually, deal with the challenges that we're facing next year.
And when you talk about the euro as a funding currency, does that mean we're going to see a big carry trade in 2022?
I definitely think so. I mean, we saw it before the virus came along. And frankly, I mean, with borrowing costs so low here in Europe, it's almost a no-brainer. I mean, the currency isn't that volatile. You know that the dollar is going to go up. You know that borrowing costs are really cheap here in Europe. Why not? You would come to Europe, you would raise your cash, and then you would swap it out to something else. It makes sense.
Donna, in terms of currency volatility, the lira really has stolen the spotlight to end this year. Now, we did see the lira gain last week when you had the government implementing measures to try to soothe and try to hedge out some of the issues for retail investors in the lira. But this week, those gains have turned again into losses. Does this signify that the market is not confident that what Erdogan's government has done will be enough to stem the pain in the lira?
Look, there are several things at play here with the lira. On the one hand, you've got policies that are coming on a drip basis. And as any investor would, they want to wait to see what all of the policies are going to look like. So for a lot of people, they are waiting on the sidelines and waiting to see if there are more measures that are going to be put in place. That's one aspect of it. The other aspect of it is that the nation relies very heavily on foreign cash. When you're a net importer, you need those dollars. So for that reason, it's not that simple to just say, come and keep your savings in lira, because eventually the dollar is going to be needed.
All right, Donna, thank you very much for joining us on this New Year's Eve. Enjoy the holiday. That's Bloomberg's Donna El Boltaji. Now, Matt, I realized that when we did our market checks, we didn't hit Bitcoin at all, which I feel like is a daily asset for you. So I'm kicking off our pre-market movers with Riot Blockchain, because we are seeing Bitcoin claw back some gains. It's up a similar amount to Riot, up about 2%. Of course, any of the Bitcoin companies doing better in this pre-market session, really after getting beat up for much of the past week. We saw Bitcoin decline back below $50,000, which some analysts pointed to saying, okay, this is maybe a concern for risk appetite, but at least to close out the year, getting a little bit of reprieve. Now, I'm also looking at cruise lines today. We had the CDC out with a warning yesterday that hit cruise lines, saying there's concern about taking them. It's the highest risk that they can assign to a type of activity. Now, we're seeing Royal Caribbean fall again today, 0.7%. I find this interesting because Carnival pre-market is actually rebounding. So we're seeing, at least for today, a divergence between the two. Now, it might be because Royal Caribbean yesterday also said that they're seeing lower bookings. And finally, Tesla, a little bit easier today of a day after we saw them recall more vehicles, Matt, down about 0.6%. Fascinating story. It was a big recall for Tesla, but of course, Matt, you know this very well. In the industry, recalls aren't that unusual.
Yeah, no, recalls are something that happen on a pretty much daily basis across the industry, but always interesting to watch Tesla move in the pre-market. It's a dependable mover on most U4. Coming up, it's New Year's Eve, but how should we celebrate with a virus on the loose? I'm actually debating that question with my wife tonight. We'll get the latest on the global COVID situation with Dr. Claire Steeves, Senior Clinical Lecturer at King's College London. That's next. This is Bloomberg. Welcome back on a New Year's Eve morning. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Danny Berger in London. Now, the number of new COVID cases continues to climb to eye-popping levels globally. It hit 2 million new cases for the first time in one day yesterday. That's the fourth straight day that we've had more than 1 million. And as cases rise, at least 2 Wall Street banks are allowing their staff to work from home. For at least a few weeks, JP Morgan and Citi are offering their employees the option of working remote for the opening weeks of 2022. That kind of asks the question, what about tonight? Because a lot of us have plans that involve less social distancing. Joining us now is Claire Steeves, a Senior Clinical Lecturer at King's College London, out of Wiltshire in England. Claire, thanks so much for your time. Happy New Year's Eve to you. What should we be doing? You know, I mentioned before the break, I want to go to a small gathering of friends tonight. My wife does not. We're going to be, splitting up. The debate is who gets to take the baby. Should we be worried? Should I be worried?
Well, I think after such a terrible year, everybody wants to celebrate, don't they? So we've got to celebrate in some way. But there's no doubt about it that if you're in London, certainly, you've got a very high chance of catching COVID if you go out and party. So I think probably the thing to say is if you're fit yourself, make sure you take as many precautions as you can, take a lateral flow test before you go out. But maybe over the next few days, you need to consider yourself as potentially infectious. This Omicron variant is incredibly transmissible, and it seems to be transmissible faster than other variants. So the chances are, if you go out and mix with lots of people, if it's prevalent at 1 at 16 in London at the moment, it's likely you're going to meet somebody who's got COVID and you might well catch it. Let's hope it won't be dangerous for you, though.
Yeah, well, so how reliable are these lateral flow tests? I'm going to take one, and I know in a lot of countries they're difficult to get hold of. Here in Germany, it was much easier, so we've got a box of like 250 at home. Everyone who goes out tonight or with me is going to be taking one beforehand. Can we be relatively confident in the results of those tests?
Yeah, I think that the tests are pretty good now. They're not 100% accurate though, so it is possible to still have COVID. And I think the other thing that's quite useful to know is that as any symptoms like a sore throat or sneezing or feeling like a bit of a head cold, that could be a sign that you've got COVID. And some people don't test positive on the lateral flow until a few days in.
Yeah, this is the interesting thing to me. If one, it's difficult, as it is here in London, I've been to many booths, I can't find lateral flow tests there. If it's hard to get your hands on a test, if the symptoms much now reflect a common cold, how many more cases of COVID do you think that we as a population have that are actually being reported?
Well, we within Zoe, so I'm one of the scientists on a big app in the UK, which we've been running since right at the beginning of the pandemic. And we've been looking very closely at what are the very earliest symptoms of COVID. And at each variant, we've been looking at that. And with this variant Omicron, especially in the context of vaccination, we're seeing the symptoms are really quite mild. They are like a common cold. And right now, in fact, if you've got a common cold and you're in the UK, 75% chance is that you've got COVID, not another cold.
Yeah, that is really striking. But if symptoms are more reflecting common colds, it's been really easy for a lot of people to say, okay, why can't we get back to normal life? I just have a scratchy throat, I have a runny nose. What's wrong, or maybe what's correct in that type of thinking?
Well, there are two reasons why that's problematic. First of all, while most people get a common cold, if you've not been vaccinated, or if you're quite frail and have been vaccinated, you actually could still get a severe disease and then go into hospital. And if millions of people within a population get infected, that means the burden on hospitalizations goes up. And now at the moment, what we're seeing is this Omicron variant is moving into the older generations, in which case we're going to see more people that are likely to need hospital. And that puts a big burden on hospitals. But there's a second thing as well, which is that, of course, if loads of people are off sick at the same time, it means that all our sort of emergency services, including healthcare and schooling when schools go back, will be at risk because people won't be able to work. They'll have to isolate.
In terms of where this is going, Claire, we saw just a few days ago 1 million people, then 173, now more than 2 million people globally infected each day. Are we all going to get this?
It looks pretty likely that it's going to, really go through the whole population. In London, interestingly, we in our Zoe data, we're now seeing that symptomatic cases are starting to look like they're leveling out. So it may be that London is going to follow South Africa in the next couple of weeks and come back down again, and then the rest of the UK might follow. What happens in places like Germany, where actually already cases are down because they've instituted strict measures, that's going to be very interesting because at some point those measures are going to have to be lifted.
Well, to bring this conversation full circle, Claire, if we do see many people going out celebrating New Year's, what does that mean for the trajectory of COVID cases? Are you expecting a spike? Are you expecting a quicker peak following New Year's celebrations?
Yeah, so I think it all depends on how sensible people have been. I think in Christmas time, we've seen in the UK, there's been no national measures introduced, but people have been quite careful. I think it's going to be very interesting to see how people behave over New Year's. Inevitably, it's going to kick up the cases a bit more, but hopefully that's going to remain within the younger population and not be a really big jump. And then we might be able to see the numbers coming down in January.
Claire, thanks so much for joining us. We hope you have a safe but celebratory evening tonight. Claire Steeves there, a senior clinical lecturer at King's College London, talking to us about the COVID. Coming up in the next hour, more on the virus with Dr. Andrew Pekosh, Johns Hopkins Bloomberg School of Public Health professor. He is a virologist, and he has been giving us excellent advice all year long. Look forward to wishing him a happy new year. And you too, this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Danny Berger in London. Let's get your first word news for you on this New Year's Eve morn. The Kremlin says Russian President Vladimir Putin is satisfied with the outcome of talks with U.S. President Joe Biden. The phone conversation set the stage for 3 sets of negotiations on European security next month. The White House says Biden urged Putin to de-escalate tensions with Ukraine. The president of the U.S. warned that America and its allies will respond decisively if Russia invades that country. A devastating wildfire in Colorado has destroyed hundreds of homes and forced thousands to evacuate. The disaster took place outside the city of Boulder. The fast-moving fire spread through neighborhoods in a matter of hours. One official says close to 600 homes may have burned down. So far, no reports of casualties. In China, the manufacturing sector kept expanding this month. The official manufacturing purchasing managers index rose above the level that separates expansion from contraction. That provided some relief to Beijing while it struggles with the property market slump. And the Port of LA will start charging a fee next month on ocean carriers that fail to pick up empty containers from the docks. The LA port is the largest in the U.S. for container traffic. It's also the main gateway for imports from China, and the buildup of cargo there led to goods shortages and price hikes before the holidays. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Danny Berger in London. Kailey Leinz and Anna Edwards are off celebrating New Year's Eve earlier. We have preparations. As you can see, Danny, not everyone on radio can see. Actually, nobody on radio can see what I'm pointing at. The Brandenburg Gate, they're prepping for a big concert. I don't know who's playing. I've heard them practicing the last couple of nights. I think it's someone famous. But I'm pretty pumped.
Well, Matt, you luckily are leading programming today on Bloomberg TV, so maybe you'll be there when they start. Front row seats right there at Bloomberg HQ in Berlin. Sadly, in London, it does not seem like there will be much celebration. It seems like everything has been canceled.
Well, surely you have a party to go to.
Yeah, I do. A party where everyone will be taking lateral flows before and, keeping our distances as long as we can.
Yeah, absolutely. They should put out lateral flow tests for 2022, instead of the glasses, the silly glasses that people wear, because everybody at my party is going to be taking those as well. What are we seeing in the markets?
Yeah. Well, Matt, unfortunately, it looks like we're not shaping up to close out 2021 with more record highs. We've seen 70 so far in the U.S. equity market, but we're looking at a softer pre-market indicator from S&P 500 futures, which are lower by 0.1%. Similar when it comes to the Europe Stock 600 as well. This has also failed to hit a new record high this week, unlike the S&P 500 did. We're also seeing NASDAQ futures, small caps also lead some of the declines. Now, we're also looking at NYMEX crude falling today about 0.7%. It's hard to divine really any sentiment from the market, given that it is the end of the year, given that liquidity and volumes are low, and sometimes this is the period where people will just do window dressing to close out the year. However, crude on track for its best year since 2008. This will not derail it. And finally, Bitcoin is up above $48,000. Of course, it did fall below $50,000 this week, holding below that level, but it's up 2%. It's fallen most days this week, so a little bit of reprieve for the ultimate risk indicator. Now, pre-market, because Bitcoin is doing better, we're also looking at all of the Bitcoin stocks. So Riot Blockchain, Marathon, those are up to a similar degree, 2.5% for Riot Blockchain. Royal Caribbean is falling pre-market, down 0.7%. This follows the CDC's warning yesterday of caution if you're planning on getting onto a cruise. We are seeing Carnival stock rebound pre-market. Royal Caribbean, however, has been unable to do the same. They've also warned that they're seeing more cancellations because of Omicron. And finally, Tesla down 0.5%. It fell about 1.5% yesterday after recalling some of their vehicles due to trunk issues, also due to camera issues as well. Of course, Tesla has had a stellar year, Matt.
Yeah, absolutely. All right, Danny, thanks very much for that snapshot. Now, Bloomberg opinion columnist Mohamed El-Erian sees a trifecta of risks facing the U.S. economy in 2022, including the Fed's delicate balancing act with rapid inflation doesn't want to slow down growth. El-Erian spoke with Jonathan Ferro yesterday.
I always say better late than never, but let's not kid ourselves. They are still way too stimulative for what developments are and what forecasts are. So if I were them, I would accelerate even more the taper so that I don't risk a big policy mistake in the middle of next year. So yes, it's good news, John, that they have pivoted. I wish they had done it earlier, but they're still behind the curve.
Given where real rates are, deeply, deeply negative, Mohamed, they are still highly accommodative, as you point out. I'm trying to understand when they start to become more restrictive. It's certainly not after one interest rate hike, may not be after 5. Mohamed, where do you think they become more restrictive, where their policy actually ends up seeing tighter financial conditions?
And that is the big question. We don't know. And that's why you want them to start early and go slowly, because we're trying to find that point. You know, ironically, even though they've pivoted, even though they have accelerated that taper, financial conditions have loosened, John. They've actually loosened, which shows you that we're nowhere near the point where policy is having an impact.
You said that if they go earlier, they can go slower. If you think they're going later, do you think they're going to have to go quicker as this year picks up in 22?
That's my biggest fear. That is absolutely my biggest fear. And that's why I've been advocating since last April that they should have started, is you don't want them to have to hit the brakes hard. Look, we're just easing our foot off the accelerator. So the last thing you want is for them to have to pivot really quickly to a hiking cycle, because remember, they're dealing with an economy and they're dealing with a market that has been conditioned for years to live with floored interest rates and massive and predictable liquidity injections. So this is quite a change, and that's why you don't want the change to be too abrupt.
Mohamed, you and I sat together, and it was in London, it was not in New York, just before the Fed was about to embark on its last tightening cycle. And I asked you to characterize what you might expect, and you said to me, I expect the loosest tightening ever by a central bank. Let's start there. How would you characterize it this time?
So it's harder this time because we have inflation. That's why the inflation call is so important. When we didn't have inflation, the Fed could end up being loose for long, and nothing would happen other than elevated asset prices. Now with inflation, we are seeing behaviors change. You know, it drives me crazy when someone said on your show the other day, we're going to be transitory for longer. Well, transitory for longer doesn't make any analytical sense because behaviors change. And we're seeing that. We're seeing price setting behavior change. We're seeing wage bargaining behavior change. We're seeing consumption behavior change. So what's different this time around, John, is that inflation is changing behaviors. And the Fed has to be very sensitive to that.
Mohamed El-Erian there, Bloomberg opinion columnist and Queens College, Cambridge president, speaking with the birthday boy, Jonathan Ferro, yesterday. Today is John's birthday. Happy birthday, buddy. Now, Semin Soher Power, Bank of Ireland Global Markets head of inflation trading, joins us now for more. She was the best predictor of inflation, spot on this year. So congratulations, first off, to you, Semin. What helped you make the right prediction? I mean, Mohamed was pretty much on the money, too, with his concerns, his warnings of the Federal Reserve, but no one else nailed the number like you did. Why is that?
Hi, Matt. Thanks for having me on. I guess growing up in emerging markets, you do grow up with a different mindset. So maybe market participants who are influenced by what has been happening in the developed markets for the last 10 years or more since, let's say, the global financial crisis, maybe their expectations adapted to this low growth, low inflation, secular stagnation regime. Whereas in my case, living with high inflation for a long time, maybe I might be able to spot those patterns of price increases more quickly. With high inflation, inflation becomes the topic of every conversation, like we've seen this year in developed markets. People are always focused on how they can preserve their purchasing power with asset price reflation. And in emerging markets, we always see people saving gold or real assets and foreign currency. And this year, the conversation was very similar in developed markets, with people looking to crypto and gold and real assets as well. So the change in inflation, as Mohamed El-Erian mentioned as well, does affect saving patterns and spending patterns. And maybe being familiar with those patterns helps me react faster to data in events.
Semin, I really do love how you talk about also your experience growing up in Turkey, really shaping those views as well. On that same vein, looking at what's happening to Turkey now, the high inflation, the interest rate cuts, are there any takeaways and lessons to be learned from this year as it relies to inflation globally?
In Turkey, the next elections are scheduled in 2023, but there are also rumors of possible early elections. So announcements like the 50% increase in minimum wages or the 1% corporate tax cut for exporters should probably be seen in that context. Obviously, unorthodox monetary policy measures have triggered a sharp depreciation of the currency this year. And if anything, going forward, probably it will get a bit more complicated as the Fed and other developed market central banks have either started with their rate hike cycle or are about to start. And interest rate differential between Turkey and other countries will widen further. So Turkey will be very much the outlier in that environment. And it will be difficult to avoid further depreciation of the currency. And recently we got an announcement of a number of new savings instruments for locals, linking domestic lira savings to currency moves, which might weigh on public finances as well if the currency depreciation continues.
Well, perhaps to a lesser extent of divergence between different central banks. We also look at the ECB and Fed as another area of divergence. But I do wonder, as we continue to see power prices, energy prices rise in Europe, what sort of inflation we should expect for the euro area, despite an ECB that does appear to be more accommodative than some of its other Western counterparts.
Yeah, obviously, currently we are seeing an energy crisis, which is the result of underinvestment into energy sector. And we also had very low inventories as Europe is transitioning into clean energy sources. But looking at where the prints are now, even though current energy price spikes introduce further upside risks near term, we still believe that Q4 print should be the peak. And due to energy base effects throughout 2022, we are expecting lower inflation prints in Europe. Still, if you look at ECB's own inflation forecast, they are looking for 3.2% year over year as well. So we will not be quickly returning to pre-pandemic low inflation levels. But I guess looking at the picture from ECB's point of view, they are seeing the growth very much supported by the next generation EU fiscal spending package. They are looking at 10-year core European real yields, which are below minus 200 basis points. They are looking at inflation expectations, 5-year forward is around 195. So very close to ECB's 2% inflation target. So very much re-anchored in line with ECB's inflation targets. And they are really not under pressure to deliver a lot more monetary policy accommodation at this point. And that's what we heard from them in their December meeting. And since the ECB meeting, actually, we have heard from a number of ECB speakers as well. For example, ECB's Wunsch was mentioning that he believes ECB has already reached its inflation target. And Hosman was on the wires yesterday mentioning that rate normalization he was calling for rate normalization already in 2022. So
so many.
It will remain.
So many speakers, Semin, that I had to disable my ECB alerts on the Bloomberg because it was just crowding my inbox. The ECB alerts are plentiful for sure. Semin, thank you so much for joining us. Semin Soher Power, Bank of Ireland Global Markets Head of Inflation Trading. She nailed the 2021 call and forecast more than 7% inflation in the first quarter for the U.S. in 2022. Coming up, we're going to talk cars. What does the industry's recovery look like in the face of Omicron? Are supply chain bottlenecks easing? And how quickly will we see the rise of EVs? Tom Narayan from RBC Capital Markets joins us. This is Bloomberg.
We are accelerating our path towards full electrification, and in fact, we're really going to go for it and see if we can convert our whole portfolio to fully electric by the end of this decade.
2022 will be the last year of a firework of combustion engines only, and then in 23 and 24 we are going to hybridize all our lineup.
If the car industry go into electric, I'm quite sure also investment will follow. We need to be able to charge all of those cars in a climate good way.
The electrification on the motorbike side goes much slower than on the car side. I think it's also not so necessary because it's only a small proportion of CO2 emissions, very small.
Excellent collection of auto executives' thoughts there on electrification. Herbert Diess, by the way, from Volkswagen there, talking about the motorbike side, because of course Volkswagen owns my favorite brand, Ducati, and they are making the electric bikes for the MotoGP electric race series. So I always pepper in questions about Ducati with him. His business is much bigger than that, though. The auto industry has stalled in 2021 after a disappointing year in 2020 due to the pandemic. People continue to work from home. Semiconductors continue to be in short supply. Electric vehicles maybe outselling traditional autos, but there still is a long, long way to go. And actually, are electric vehicles really outselling traditional autos? I highly doubt that. Joining us to map out the shape of the car market in 2022 is Tom Narayan, lead equity analyst for European autos at RBC Capital Markets. Tom, thanks so much for joining us on this New Year's Eve. What's the sales numbers look like right now in terms of EVs versus ICEs?
Yeah, it's definitely not outselling ICEs, but definitely you're seeing penetration levels exceed 10, even to 15% in Europe. In the US, obviously, it's a little less than that. But yeah, new sales, we're talking about that kind of maybe 10% range in Europe, maybe high single digits in the US. But that's obviously going to ratchet up, I would say, the mid part of the decade. For 2025 to 2030, that's when the real kind of asymptote really happens.
Is it the infrastructure that's the problem, Tom? I mean, I'm sure a lot of people are thinking about buying an electric car who haven't already, but are wondering, where will I charge this thing? When I go to work and park it, there's no place to plug in. At home, I've got to install something special. Is that the problem?
Two problems. Number one, charging infrastructure, absolutely, particularly in Europe, where in some countries it's just abysmal. And the second issue is the EVs that we've had so far, to be quite honest, haven't really been that compelling. You've just had one brand, Tesla, that has vehicles with ranges that are kind of acceptable. Even though the average commuter in Europe only does 50 kilometers a day, psychologically, we want to make that one trip to grandma's house, that where we need the 300 miles. But fortunately, this coming year, you're going to start seeing, as you know, Matt, tons of new models coming out with ranges far in excess of 200 kilometers, 300, 400 kilometers. And so I think finally you're going to see that change. But yeah, I would say charging infrastructure, number one, and then it would be vehicle range. And really exciting models. You really haven't had a lot of exciting models. That's about to change this year.
Yeah, hopefully they come out, but there's been huge delays, right? For example, I'm hoping for a Ford Lightning. I want to see a GMC Hummer, but I'm not confident they're going to come out terribly quickly. My buddy John Farrow, whose birthday it is today, happy birthday, John, raised an interesting point yesterday. Do you want to buy an electric vehicle, a fully electric vehicle, not knowing how you're going to deal with a battery failure in 10 years if that happens, right? They're not easy to just swap out. They're built in as part of the car.
I mean, I would argue that you're really comparing it to not EVs in 10 years. You're comparing it to ICEs at this point, right? So if you're an EV maker, your goal, your bogey is the ICE cars right now on the road, not future EVs. And so from that context, you know, your Ford Lightning that you're going to buy, you're not going to have to do oil changes. You can charge it at home like your iPhone instead of having to go to a gas station, which to this day scares me. And there's far less components in these cars, right? There's far less parts to go wrong. Acceleration is better. Oh, and it's better for the environment. So to me, that really is the argument is, you know, how does it compare versus traditional ICEs? Less so about EVs 10 years from now. I just don't think people are doing that kind of calculus. Most folks only own their car for a few years anyway, and then, you know, lease it and then swap it out anyway.
Tom, Danny here as well. Good morning to you. Thanks for getting up early for us. Really interesting in your research, you write that emerging markets should account for almost all the growth in the coming decade. Does that suggest that Western markets, developed markets are already saturated, or is just the growth so significant from emerging markets that it dwarfs those of the rest?
Yeah, that's really the scary thing that I think folks aren't talking about. I mean, yeah, it's just a demographics thing, right? Western Europe, the U.S., these are, you know, markets where you don't see population growth as much, right? And these are mature auto markets. In some countries, populations are even potentially going to decline, right? Italy, Germany, and so emerging markets, huge movements from, you know, rural to urban. We've seen this play out for, you know, for a while now. But yeah, over the next several decades, most of the growth in the auto market for new sales is going to be predominantly South Asia, Southeast Asia, and in the next, you know, 50 years, Africa. So that's something that I do think automakers are going to have to, you know, start looking at. And it could actually, by the way, save the ICE. To some extent, or at least lengthen that tail.
Tom, we saw Rivian there. I forgot to mention that in the electric pickup trucks that are exciting. If I want to make a decision to buy a Rivian today, or order a Hummer, or order a Lightning, how long am I waiting?
Oof, now you stumped me. Yeah, it's really unclear. I mean, as you know, they have these targets, right? I think the Rivian is supposed to be the first quarter of 22, and electric Hummers sometime in 22 as well, and
right.
Yeah. So these are the targets that they've laid out. Unclear if they start slipping or what. You know, we'll find out soon.
Yeah, we've seen, I think, big delays. Tom, thanks so much for getting up early out of Miami. Really appreciate it. Tom Narayan there of RBC Capital Markets. This is Bloomberg.